Earlier today, S&P 500 futures surged above 7,534, capping 8 straight weeks of gains, the longest winning streak since 2023, on news that President Trump's memorandum of understanding with Iran is, in his words, largely negotiated. Brent crude has dropped roughly 6% in 48 hours, falling back towards $96 a barrel from a 2026 high of around $127, and a high-level Iranian delegation, including Foreign Minister Abbas Araghchi, has arrived in Doha for further talks mediated by Pakistan and Qatar. However, while Wall Street is pricing in a frictionless return to normal, the actual structure of the deal being negotiated and the physical state of the global oil market tell a markedly less reassuring story. So, in this video, we're going to take a look at what's actually on the table in Doha, why the physical commodity data is flashing red, and why a number of analysts are drawing uncomfortable comparisons to the relief rally of 1973. Let's start with what is and isn't in the framework being negotiated. According to reporting from Doha, what's on the table is not a permanent settlement, but a 60-day extension of the fragile ceasefire that's been in place since April 8th. During that 60-day window, the Strait of Hormuz would reopen, Iran would be permitted to sell oil, and the United States would lift its naval blockade of Iranian ports. For context, the Strait of Hormuz carries roughly 20% of the world's oil and LNG, about 20 million barrels per day, and has been under effective blockade since early March. However, the most difficult issues, namely Iran's stockpile of around 440 kilograms of uranium enriched to 60% purity, and any long-term restrictions on its nuclear program, are being deferred into that 60-day negotiating window, not resolved by it. Iranian Foreign Ministry spokesperson Esmail Baghaei has explicitly said the nuclear file is not part of the current discussions and that Tehran's focus is, quote, solely on ending the war. U.S. officials, by contrast, claim Iran has agreed in principle to dispose of its highly enriched uranium, a claim that Iranian state media has directly contradicted and for which no verification mechanism has been agreed. Trump himself has put the odds of a deal versus resuming strikes at, quote, a solid 50-50, while Secretary of State Marco Rubio has warned that a nuclear deal cannot be achieved, quote, on the back of a napkin. Critics, including Senator Roger Wicker, have argued that once the strait reopens and Iranian oil flows again, Washington loses its primary source of leverage, while Iranian hardliners are publicly labeling the deal a bluff. In other words, what markets are pricing as peace is really a 60-day pause, with every structurally difficult question pushed to the back of the queue. And this brings us on to the physical data, which is arguably the more important story. According to the EIA, U.S. commercial crude inventories fell by 17.8 million barrels in the week ending May 15th, the largest single-week draw on record. Bob Yager at Mizuho estimates that at the current pace, inventories will dip below 400 million barrels within 9 weeks, a level not seen since 2014. Goldman Sachs estimates the disruption has already pulled nearly 500 million barrels out of global stockpiles, and the U.S. Strategic Petroleum Reserve has fallen below 375 million barrels. Sparta Commodities estimates that 10 to 11 million barrels per day of crude remain shut in for every day the strait stays closed, while Barclays' upside scenario models a shortfall of as much as 14 million barrels per day. Saudi Aramco's CEO Amin Nasser has warned that global supplies may not normalize until 2027. Crucially, even if a deal is signed tomorrow, analysts say physical recovery is a minimum of 3 to 6 months away, with logistics specialists pointing to at least 52 days just to restart tanker flows out of the Gulf. JP Morgan warns that some developed economies are, quote, days or weeks away from hitting operational minimums, and Jeff Curry, formerly of Goldman Sachs, has warned that once those minimums are breached, prices could go, quote, non-linear. For context, we've seen this kind of divergence between paper markets and physical reality before. In 1973, markets initially rallied when the OAPEC embargo was lifted in March 1974, yet the Dow went on to hit new lows that July, and the S&P 500 ultimately fell by roughly 48 to 52% from its January 1973 peak, taking more than 9 years to recover in real terms. The energy shock didn't crush the market on the day of the headline. It crushed it over the subsequent quarters, as higher input costs ground their way through corporate earnings. Today's disruption, via the Strait of Hormuz, is several times larger in volume than the 1973 OAPEC embargo, and it's hitting an economy with the 30-year Treasury yield above 5% and year-ahead inflation expectations at 4.8%, up from 3.4% in February. Ultimately, the gap between what the paper market is pricing and what the physical market is signaling has rarely looked this wide. Wall Street's algorithms are buying the word peace, but the record inventory draws, the analyst forecasts from Mizuho, UBS, Goldman, JP Morgan, and Barclays, and the structure of the Doha framework itself all suggest the actual energy shock is far from over. Whether markets are forced to confront that in June, in July, or only after the 60-day window expires and the underlying nuclear questions return to the table remains to be seen.